With President Barack Obama this month proposing the historic step of regulating carbon dioxide emissions from US power plants for the very first time, several states are thinking about whether cap-and-trade mechanisms might be the best way to meet their new obligations. The great advantage of cap-and-trade systems is that they're market-based, allowing the private sector to determine the most cost-effective ways to cut emissions. They work exactly the way they sound. An emissions cap is set for the area covered by the programme, typically as an allowed rate of output. These caps are often set to ratchet down over time to meet emissions reduction goals. Then permits are allocated to the emitters, power generators and others, who need to show they have enough to cover their emissions for the period, usually a year. The permits can be sold at auction or just distributed based on expected output. If a company has more permits than it needs for its level of emissions, it can sell the excess. And if a company needs more permits, it can buy them. Because companies have a choice between cutting emissions and needing additional permits, the price of the permits will converge on the marginal cost of making those cuts. And that should mean the cost of the overall emissions reductions is the lowest it can be.